Welcome back to Am I Catching a Falling Knife, the podcast where we break down complex financial moves into simple, actionable insights. I'm your host, Dave, and today we're dissecting a stock that has certainly felt the squeeze recently, Spotify, ticker SPOT. Over the last few days, SPOT has dipped a cool 12.73%, making us wonder, is this a temporary blip, or are we looking at a classic falling knife scenario? Let's find out. All right, let's dive into Spotify, ticker SPOT. The single most dominant market narrative right now is all about their profitability outlook, even amidst what looks like strong subscriber growth. While Spotify did report robust user and subscriber growth for Q2 2025, which is fantastic, it's their bread and butter, they also missed revenue targets and forecasted lower than expected Q3 profit. The main culprits? Higher employee-related taxes, often called social charges, and currency impacts. This has definitely created a bearish sentiment, even though, fundamentally, their core business seems pretty strong. Now, for those new to Spotify, they are a leading audio streaming and media service, founded way back in 2006. They've built this massive catalog of music, podcasts, and audiobooks, all offered through that familiar freemium model, a free ad-supported tier, and a premium subscription service. Most of their money, about 87.3%, comes from those premium subscribers, with the remaining 12.6% from ad-supported services. Their mission is truly to unlock human creativity and give artists a living while connecting billions of fans. They're clearly aiming to be the world's #1 audio network, expanding heavily into podcasts and audiobooks. So, how did we get to this estimated 18% hit on their profit outlook? Let's break down the mechanics. First off, Spotify's business, as we just discussed, is almost entirely driven by premium and ad-supported services, which directly tie in to user and subscriber growth. The market narrative confirms they had robust Q2 25 user and subscriber growth, which, on its own, should be a big positive for revenue. However, the narrative also explicitly stated that they missed revenue targets and, crucially, are forecasting lower than expected Q3 profit. This tells us that even with those growing subscriber numbers, either their revenue per user is under pressure or the market's prior expectations were just too high. The key factors specifically identified for this negative profitability outlook were higher employee-related taxes or social charges and currency impacts. These aren't just minor nudges, they directly increase Spotify's operating expenses or reduce the translated value of their international revenue, which hits their gross margin, reported at about 31.1%, and ultimately their net profit. When the company itself gives guidance for lower than expected Q3 profit, the market reacts by pricing in that anticipated decline from what was previously expected. Given this combination of strong growth but explicit guidance for increased costs and negative currency effects, we're estimating a significant but not catastrophic reduction from prior earnings expectations, somewhere in the ballpark of an 18% negative impact. To figure out what this stock is really worth, I'm looking at this from a couple of angles, pulling data straight from finviz.com. First, a discounted cash flow, or DCF model. For this, I'm assuming a growth rate of 41.82%, a discount rate of 9.5%, and a terminal growth rate of 2.5%. Based on those assumptions, our base case DCF value for SPOT comes in at about $394.35. Now, here's where our narrative comes in. When we factor in that estimated impact from the social charges and currency headwinds, our narrative-adjusted DCF value drops down to roughly $307.59. The second method is a bit simpler, a PEG-based valuation. This looks at the price-to-earnings ratio relative to the earnings growth rate, and this method gives us a fair value of around $380.77. So, with SPOT currently trading at $620, both our valuation models suggest a significant discount from the current price, especially when considering the short-term headwinds. Given all this, some potential buy levels I'd be watching closely are $390 $375, and if things get really choppy, $325. So, to wrap things up on Spotify, remember, this podcast is for informational and entertainment purposes only and is not financial advice. Always do your own thorough research and consult with a financial professional before making any investment decisions. Thanks for tuning in, and until next time, keep those financial minds sharp.